You want to know how much home you'll qualify for based on a $75,000 a year salary. I will break this down for you, but just to be honest, this video is not to teach you what you should budget for. This is to teach you what you will qualify for according to loan guidelines. And those are two different things. You may qualify for a certain amount based on your credit and income and all those factors, but ultimately you need to decide if you're comfortable with that amount and if you'd be okay with making those payments. Don't ever rely on a lender like myself to tell you how much you can afford. That's not for us to say. We can only tell you what you qualify for based on the loan guidelines. Now, I'm going to break all this info down for you based on purchasing a home here where I am in Las Vegas, Nevada. Now, most areas are the same or very similar as far as like what the monthly taxes and insurance are going to be for a particular home. And those factors go into determining what you'll qualify for. But there are some outliers where, like, for example, I do home loans in Texas, and I noticed the taxes are substantially higher in most areas in Texas compared to areas in Las Vegas. So you have to take that into consideration when I give you these numbers. One other quick thing is that I'm going to give you a very general explanation here. I don't want to complicate things too much and confuse you, but I'm not taking into account all the different ways we have to calculate income here. I'm basing this assumption based on an annual salary, meaning you get paid one amount of $75,000 a year, and we divide that by 12 months, and that amount is used to calculate your monthly qualifying income. Now, if you get paid $75,000 a year, but you're not paid based on annual salary, maybe you're paid by the hour and your hours fluctuate, or maybe some of it's base pay and some of it's commission or overtime, or maybe you get a small salary and the rest is bonus and commissions and all that. There's a very specific way we have to calculate that income. We have to usually average it over the last 2 years. And odds are, if you don't work at a mortgage company, you're going to have a hard time accurately calculating it yourself according to the exact loan guidelines. And that's why you would always want to rely on a mortgage professional to calculate this stuff for you. So now that's all out of the way. And now I can move on to your debt to income ratio. And I'll refer to this as DTI. And the DTI is arguably the most important factor in determining how much you qualify for. DTI is a percentage that compares your monthly debt to your gross monthly income, which is the amount of income that you earn before taxes are taken out. So for example, if your salary is $75,000 a year, that means your income is $62.50 a month. Now that won't be your monthly take home because you'll have like taxes, insurance, Social Security, stuff like that deducted out, and then the remainder will get deposited into your bank account. But as far as your DTI is concerned, we look at the gross total number before any of that stuff is taken out. Now, there are two types of DTI that lenders have to look at. The first is called the front end ratio, and that consists of your total housing payment. So that's like principal and interest, property taxes, homeowners insurance, mortgage insurance, and then HOA dues. The back end ratio is your total debts. So that includes the housing payment plus any other debts that you have. And also things that are included in this are things like child support and alimony, things that you have to pay every month. Things that are not included in this ratio really are just anything that's not a debt or not court ordered. So this is like your phone bill, your utilities, stuff like that is not included in that ratio. Lenders don't really focus much on the front end ratio these days. It is still relevant in a lot of scenarios, but what's more important is the overall back end ratio, the total debt to income ratio, and that's what's mostly considered when determining your home loan options. Now, we calculate the DTI by dividing the total monthly debt into the total monthly calculated income. Generally speaking, a home buyer can have a max DTI ratio of 49.99%. Now, I want to put a lot of emphasis on the words generally speaking, because there are multiple different loan programs that you can use, and they all have different requirements, and some will allow a little bit less than 49.99, some will allow a little bit more, but the major programs that we would look at will often allow you to go up to that number. So that's what we're going to assume for this explanation. So just as a quick refresher, if your annual salary is $75,000 a year, your monthly qualifying income is $62.50 a month. So 49.99% of that comes out to $31.24. Let's do this calculation in reverse. If your total monthly debt, including the housing payment, was $31.24, we would divide that into your monthly income to determine the DTI. So $31.24 divided by $62.50 equals 49.99%. Now again, that $31.24 is the maximum amount that your total monthly debt payments can be, including the total housing payment that you plan to buy and any other car payments, student loan payments, credit card payments, any other debt payments like that. Okay, so here's how we figure out what your maximum housing payment can be. Let's assume you have a $500 car payment and no other debt. We would subtract that out of the total allowable monthly debt, and the maximum housing payment would be $2624. So now we need to see how much house would a payment of $2624 get you. Now again, I don't want to make things too complex. So for this example, I'm going to assume you're using a 30-year fixed FHA loan. There might be other loan programs that you might use, like a conventional loan, a VA loan, a USDA loan, but FHA is a pretty forgiving option, meaning it's going to be available to a larger pool of buyers. And the payment is going to be often similar on an FHA loan as it would be for a conventional loan, which is the other common option. So I pulled up a real life example of a home for sale here in Las Vegas. I'm going to break down the total housing payment, and then I'll go over the price and the minimum down payment based on that FHA loan. A total mortgage payment consists of PITI, which consists of principal, interest, taxes, and insurance. In this example, your principal and interest would be $22,1937. And that's based on the current interest rate of an FHA loan of about 6.125, depending on your credit score. I would estimate your homeowner's insurance at about $100 a month, but there's really no way to determine exactly what that would be until you actually find the particular home you're purchasing and you get quotes from homeowners insurance companies like all the major ones like Geico, State Farm, all that, and they confirm how much it would cost to insure the home. Property taxes for this example are $98.58 a month, but this is honestly lower than average. In almost all cases, when you put less than 20% down, you have to pay monthly mortgage insurance. In this FHA example, it would be $167.41 a month. This example also has a low HOA amount of $11 a month. So this brings your total housing payment to $2596.36, and that's just under the allowable limit in this example. This example is based on a 3-bedroom, 2-bath, 1,200 square foot home in Henderson, Nevada, and that home was listed at $372,000. Now keep in mind, some homes will have higher HOA dues, higher property taxes, and it may cost more to insure a particular home, and all those are going to affect your total payment, which will in turn affect your DTI and affect how much you can qualify for. FHA requires a 3.5% down, so at a $372,000 purchase price, your down payment would be just over $13,000. Now, if you don't qualify for the amount that you were hoping for, there may be some options. So you might be able to talk to your lender to see if there are any debts that you might be able to pay off to reduce your debt to income ratios. Some home buyers have the luxury of adding a co-signer who earns monthly income, maybe has decent credit and doesn't have a lot of debt, and that can help you get to a higher amount. And if you're able to put a larger amount down, that's obviously going to decrease the loan amount and help you qualify for a larger purchase price that way. Again, though, I really encourage home buyers to not simply just purchase the home at the max amount that they qualify for, but to actually sit down with their finances and make sure that any home that they're planning on buying fits within their budget. Now, one important thing I really want to leave you with is don't try to figure this out on your own. That was not the purpose of this video. It was just to give you a general idea of how things work, and that maybe will allow you to determine just very basic figures for yourself and give you a ballpark figure of where you might land. But ultimately, this stuff is very complex. There are a lot of different calculations that go into determining your home loan options. And so the best thing you could do is find a reputable lender who knows how to do this stuff correctly, and they can do a full pre-approval for you and determine exactly where you stand. I've been a mortgage loan officer for over 13 years. I've helped hundreds and hundreds of people become home buyers, and I would love the opportunity to help you out. So if you'd like to learn what you qualify for, please reach out to me. You can find my contact info in the description. Thanks so much for watching, and I hope to catch you on the next one.